Now, this is a video that's a companion video to the one I made. It's going to be about the same time, and it's about development fee theory. I am writing a book, and I am in my old age questioning all sorts of things about finance, measuring returns, cost of capital, terminal value, a lot of things. When I talked about development fees in the past, I was talking a little more from the perspective of a banker, and I was very simplistic. And the thing that I did not do ever before, now I made all these diagrams all the time, and I said, okay, what's the probability if you have to spend on a desk study? I'm going to use this vaccine and the coronavirus again, and then there's only there's a 90% chance of failure, and if you put a discount rate in, this is how much you realize. And then you get to the second stage, and now there's a 80% chance of failure, and you've spent some money in the second stage, and this is how much you get. And then you go to the third stage and you look at the probability of success and failure, which I didn't do very well, and you can get the kind of ending value. These are options to cancel. Options to cancel are most of the real options in finance. If you try to apply this real options theory, it's options to get out of something. Okay, it can be expensive to get out of contracts and all that. I know that. Now, the thing that this doesn't do, it doesn't tell me anything about how much the value of the development fee that I should theoretically put in. And my suspicion is that when people have these negotiations on the development fee, whether it's, with the developer itself, or whether it's with a off-taker, if you're the developer and the sponsor, or whether it's with or whether it's with a bank, you discuss this theory in very general terms, but that's all you do. So I've made this ugly looking diagram. I had to get the file where I said, okay, what's if the sponsor and the developer are the same? I've got to redo all of this and make it look so much better. Maybe these arrows shouldn't be so thick. God. Now, and you pay this fee and you get the fee and you can use a cash on cash equity. And then as I'm working through the mechanics of the development, I've been thinking, well, if we know the probability of getting through the different stages, can't we come up with an idea on what should this development fee be? And we should compute a lower IRR with the development fee because it's totally appropriate to allocate a, a cost to the probability of not being able to not being able to have successful projects. If you're in a corporation and a corporation is a portfolio of projects, you're going to have a lot of developments that are going to fail. And when you evaluate things like some kind of stock, this stock went way up because it's one of these vaccines or something like this, not the antibody thing or something, and they got a probability of success. The whole value of here has nothing to do with cash flows and all that, and looking at the history of the cash flows. The whole value of this corporation or this corporation is a function of what the probability is going to be. And now you could say, let's invest in all of these things. Let's invest in all of these things, put them all together in a portfolio, and maybe one of them will succeed. And then we'll eliminate kind of our development risk. That's the idea of making That's the idea of making portfolios. Now, that was perhaps a little bit of a digression, and let's go through kind of the theory of how we could figure out from our probability analysis, and I haven't really explained this. We have a probability of success or failure. I've made one case here where we have a feasibility study and then we have a negotiation, PPA negotiation, perhaps. Those are our two stages, and uh, there's a certain probability that the feasibility study will work or not, and we spend 30,000 for that, and then we have to spend 100,000 to make our PPA negotiation work. How much should our development fee be in theory? And that's why I really opened this file. I didn't finish opening it. You have to, as a sponsor, you have to negotiate with the off-taker and the lender and the developer if the developer is different than you, and you have to figure out what's the correct value of this development fee, and you can put these vague multiples of, I put a 5 times multiple, or we can put in this thing that I discussed, which is this development fee as a percentage of the project cost, but normally they seem to come from the air. I've talked to a lot of developers. How can we make it more rigorous? Now, the way I start this is I start by saying, don't worry about this. I start by saying, okay, let's say that this is a really simple bidding process. That's all it is. So right now there are, in my scenario, there are 5 bidders. So I put 1, 2, 3, 4, 5, and I made this work with 5 bidders or 10 bidders or 3 bidders, or I could add it to 20 bidders. Okay, now let's just say you all have to pay 10,000 to make your bid work. This could be 10 million, whatever, or 5 million or 1 million. You all have to pay that to make your bid work. Okay, now here's the problem. There's only one winner. So I have up here, this is the winner. And all I did was make this one the winner. Okay, what should I do here? Maybe, whatever. This is the winner, and these are the losers. Okay, how about this? Maybe I'll do this, and maybe I'll have to make it okay, so this is the winner, and the rest of you, I'm sorry, and I don't, I hate this word. It's the loser. I hate that. God, I hate that. And we only have whatever. If this is true, then we'll put it as a loser. Okay, that's the idea. All right, and so we have this time we have one winner, 4 losers, and the rest are just nothing. Okay, and now when we do this, let's just think about it. Maybe this is a pretty good case. Maybe let's put 4. So there are 3 losers and 1 winner. Okay, but you bid, 4 different times. And in the old days, I heard that this is kind of the way it worked. It was so oligopolistic, really, that I remember somebody told me, I've learned so much from taking my classes, that say they kind of said, well, you're going to win this time, you're going to win the next time, and you go around and around, you overbid, whatever, you screw the off taker and you have a nice oligopoly. Okay, and uh, then, okay, and then after that, after all of that, you uh, uh, so you lose on when you win, you want to charge a development fee that's going to compensate you for losing 3 different times. That's the trick. So right now there's a probability of success. Okay, let's move this over here of 25%. That's the way I've structured it. All right, and then there's a probability, and when you succeed, your cost when you succeed is 10,000, and you're going to recover that. That's going to be a development cost that the bank and the off taker and everybody else is going to allow you to recover. But then you also you want recovery of failed bids, okay? And that is going to be our 3,000, okay? And then I said, okay, well, let's kind of prove that this whole thing works. So we're going to go over here, and we have a probability of winning of 25%, in this case, a probability of losing. So you have 1 in 4 chance of winning, and you have 3 in 4 chance of losing. Okay, now when you win, here's what you do. You get to recover your own cost. That could be different than the other cost. And then you're going to recover this fee, which is the 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 cost of losing. And this is what we're going to have to do is we're going to have to compute the cost of what happens when you lose in all of these cases. And then we're going to have to pay uh, uh, we're going to recover this 10,000, but we're going to have to pay that anyway, so that kind of washes out. So our total amount we really recover over and above our total extra cash flow is recovery of this thing, which is this. I call this recover the development fee. I'll just abbreviate it. Okay, that's the amount we need to recover. Now, when I used to go to university, they used to tell me about expected value, and they said, well, the expected value is the probability of winning times how much you receive when you win. That's okay. And then you've got the amount uh, 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 the this is the amount if you lose, and you've got a 75% chance of losing. So this is the expected value. So I should put up here. Can I put? I think I can put one here. Okay, I'm going to put expected value, and I'm going to put down here expected value. Or I should even write it out. And this is the expected value again. Okay, and then the total expected value at the end. This is expected value from the loss and the gain on the win. Now, at the end of the day, this is what you want. The total expected value you want to be 0 after you've done everything. Okay, so that's it. All right, and then let's just make sure that that works. So this fee you recover, here's the formula. It's either the total loss, but in this case, we could put also a formula in. We could say, okay, here's the cost, G11. That's the cost for spending money on development when you lose. You divide it by the probability of success. That's over here. But then you have to also subtract the success because you're going to recover that when you win. All right. And then you can put up here, see, I need to explain this a little bit better. This is the development cost. Now I did this, of course, extremely simply. This is the cost you have. And we could have easily put a thing in, and then we have the fee, required fee. And then this is down here or up here, or we'll put it up here. How's that? And then this is the the ratio. Okay, so we have, yep, don't know how many times I've done that. Okay, we need a development fee ratio. Okay, and we could also put in here somewhere the project cost. Who knows what that is? What is that? Let's say that's 100,000, and then we could put theory a correct fee. Okay, and that's the development cost, their fee divided by the project cost. Okay, if that's very high, we'll put in a much higher cost. Okay. Uh-oh. All right. Okay. That's the idea. And that worked okay. That works okay if you can say the fee, we pay a bid, everybody has to pay the same amount. There are no gates. It's not like these other situations and finding a vaccine and or going on a date, and you go on your first date, you got to pay some money. Okay, then you go on your second date, and maybe you got to pay a little more money. Okay, that's stage two. And then maybe, oh, God knows what you do. What's stage three? I don't even know. It's been whatever. Stage three is you buy some jewelry or something, okay? And then each one has a probability of success or a failure, and then the final probability of having a happy life. That's not very good. Sorry, let's not get into that. But there, you could apply this kind of development cost analysis to just about anything. But this time, let's add this option to fail. What a wonderful thing that's in that dating thing. It would be really good. So you only spend this much for your feasibility study is up here, and then if everything works and you succeed, then you and I don't really need this stuff up here. If you succeed, then you do your negotiation. Okay, now what I did is I put a probability, P success, probability, okay, all right, and then so we have a 30% probability of getting through a first gate, and then we might fail. Oh, my friend Camillo did this with me years ago. He died. And then you can get through the second gate. Now the problem is that what we really need up here is we need to get we need to get a big list of how much what's the probability of winning. We need that. Okay, we needed that for this, and we needed that for this. And the real thing is we need the total cost when we lose, the total amount of cost when we lose. Now, if I did this 8 times, I could do this one 8 times, and we get the same kind of thing, okay? Now we have a much lower probability of winning because there are many more bidders. And that now we need a 7 times development fee ratio. And this is what happens when we succeed. Now we have to recover this much higher development cost because we have a much lower probability. So to apply our formula, let's see what we need. We need we need to sum these costs when we lose, and we need this probability of its success. We can do it like this. We can take the uh, 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 formula. This formula says take the total cost divide it by the probability of success and subtract it. So we need the probability of that. But what we really need to know is not our cost this time will not be constant because sometimes we'll cancel and sometimes we won't. So this is one of the rare times that I think a Monte Carlo simulation might be really good. What you do up here is you just put a random number in here. And then you put a thing, well, if this if this random number is less than or equal to the probability, we're going to define this as a success. That's there. Okay, now I put a little thing so I can recalculate it. So sometimes we'll have a success, and 30% of the time we won't have a success. And then if we have another success, then we get to this stage, and then we do the same thing with this probability. We say now we have a much higher probability. Now what we'll be able to do is put something like this, 20 and 80% probability in, and then we can recalculate this and see, what happens if we succeed. We have to make it out of the first gate. And if we don't make it out of the first gate, we only spent 30,000 on the feasibility. That wasn't so bad. So we don't have to waste money on the negotiation. This is this whole option to cancel, option to cancel. And then we go and do it again and again and again and again and again and again. And then here's what we can do up here. Well, we can make this one, when this is true and this is true. If this is false, we stop. If this is true and this is true, then you finally have a success. So let's kind of go around and around. Oh, I just had one. I just passed it up. Okay, come on, come on, come on. There's a true. There's another true. Okay, so we have this true up here. And when we have this true, we have to spend both the feasibility study money and the negotiation money. Okay, and if I keep going, this one, we only spent 30,000 when we failed. And this one, we spent 130,000 when we failed. So now what we can do is we can then go back here, and what we need is a kind of list like this. We need this simple list, but this time, sometimes in this case, it's going to be 30,000, and sometimes it's going to be 100,000. You see the difference, okay? Because we have the option to get out of it. So our development, our real cost and our required development fee won't be so high. But this is the final result. It's very theoretical. You're not going to really use it in your models. No, come on, of course not. But when you're sitting down and arguing with a PPA, off-taker or developer or somebody else, and when you're thinking about what should really be this development fee, how much profit should I really pay? Of course, other people might be negotiation, other people might want more or less. Or if you're deciding, should I really develop the project myself or have somebody else develop it? These are all the kind of things that you can do this. Now you could also include the cost of money and all that, but I think it's almost better to just ignore that at this stage because it's so much more dependent on probability. So now what you can do is you can put in here, let's put in a number of simulations. Okay, I'll do it like this. Okay, and let's try 1,000 simulations. Okay, now there are all sorts of if I don't stop doing this, I'm gonna go crazy. Okay, and we let's just put simulations here. Okay, now to make this work, all we do is we're going to make just a list of the simulations. We're going to put how many successes we had, and how many failures. And perhaps we should do something else. Now, what I'm trying now is something really, really dangerous. I am trying to make a video like I used to do without practicing first. I'm going to say this is about enough. Oh, shit. Just a minute. Stupid phone call. Why do they call? Okay, I just made a gigantic range name called output. Okay, and this has got, I don't know, thousands of lines in it. And what I'm going to do is delete this. We're going to make a little simulation, and I'm going to delete this range name before we start. And then we'll be able to compute the probability of success and uh, uh, the total cost of when we failed. Again, I'm gonna mess up a little bit here probably, and let's go. Okay, making a simulation with a macro is about the easiest thing you can do. Okay, because all you have to do is use a for loop. Okay, and so let's just remember that we had this simulations here. Okay, so we uh, uh, go to the for I equals 1 to range simulations. Okay, now I have just been wasting all day trying to balance the balance sheet, so my mind is a little soft here. Okay, and then we put range output. Uh, how about let's put clear? What happens if we put clear? We can put clear. We'll just put clear. It'll clear everything. Or actually, if we end up formatting it, it might be better to put clear contents. Okay, and then now what we can probably let's do something that I was going to set it to manual. If you want to set something to manual, what you should really do is put current status equal calculation dot application dot calculation. Okay, and after you do that, you then that's just a variable, and then you set the application, the calculation uh, equals. Let's put it to manual, and then every time we do it, we'll put active. We'll put active sheet dot calculate. Now we could get really fancy and only calculate if, and maybe we should do this. We only care about these two numbers. When I put this little calculate, we care about what our cost will be, and sometimes our cost when we fail was 130,000. Sometimes we succeed, and sometimes we fail. So this is our, I'll call this result. Now, when I have done this in the past, you know, this method, if you want to make your thing work uh, much more quickly, this is by far the best thing to do. Okay. And then at the very end, we better reset our calculation method. Okay. So you just go over here and you put an equal current status. Okay. And finally, then we put up here, we'll put range output dot cells. We'll put for the I for the row, and for the column we'll put equals I. That's just going to be our simulation. And then on our second column, we're going to put range result dot cells. Now we could have probably done it easier. We always just got 1 and 1. Okay, and then we do the same thing for the third thing. Okay, and range the cells, it's always 1 row. This is the second column. Okay, and this should hopefully just go around and around and do our simulation. All right, let's see if it works. And then I'm going to probably turn the video off. And there it's going. Okay, I just made one scenario. I had to change the calculation thing a little bit and make it just calculate the whole sheet. Sorry about that. But let's put the probability of success. And that's just going to be a count if, and we'll just count if all the way down, but all the way, 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 way down. And we'll just put comma true. Okay? Hope I did enough. So the successes, and then I don't know if I spelled that right. Total. So we have a probability of success of 16%. Okay, this is kind of like this. We can start to put this in. This is our probability of winning. Okay, and then we have, well, then the probability of failure. What happened there just now? Oh, no, that's okay. And the P of failure is minus this. Okay, and the cost of failure is some product of the total success. Okay, and let's go down to this one, and then go and get the total here. Okay, it doesn't work now, of course. Let's just cheat and put 5,000. And we might need to do more than 5,000. Now, the way I would test this out now, okay, oops, some product Now, I was going to tell you this. When you use a true and false, you have to put a multiplication in there, okay? I knew I purposely wanted to do that. Okay, and then we can put the average cost of failure. Okay. God. Okay, and that's just going to be this divided by this one divided by the number of simulations minus the number of successes. Okay. How's that? All right. Did I mess anything up? Okay. And now uh, uh, before I go through and make a couple of mistakes and fix a couple of the theoretical things, which are by far the most interesting, before I do all of that, let's make sure our Monte Carlo simulation is really working. So what we could do first is, now if you rerun this whole thing, okay, then you want it to give you about the same result. Okay, so I just ran it. It was about the same. I suppose I could have made 10,000 or 100 or 5. And we can see if I just run it a couple times and see if I get the same result. And then I make my crude conclusion that the Monte Carlo simulation is okay and I didn't have to waste money on at-risk crystal ball, all this junk, real junk, real junk, and I didn't make some enormous data table or anything like that. Okay. Now, here's when I did this other thing, I really should have uh, 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 made our formula like this. I should have made our formula, the real formula here is the average cost of failure. Average cost failure minus divided by the probability of success minus the cost recovered. That's uh, it's going into the other thing, isn't it? No, who gives a crap? Okay, if you do it like this, uh, that was close enough, isn't it? If you do it like this, we get our 70,000. In this case, this is the recovery fee we need. This is from a basic kind of case. So if I have four instead of 3, I have to. Oh no! Oops. Oh, okay. Oh, ah, I didn't want to do that. Damn it. I don't know what I just did. I have no clue as to what I just did. But I do know that I kind of messed up and that I did something wrong with my little thing. So if I have let's put 3. Let's put 3. Average cost of failure is 10,000. We've got a probability of success of 1/3. The loss we have if we take the average cost divided by the probability of success is 30,000. That's how much our total spent for everything. That's like we're buying all of the different vaccination stocks. Then we got to add back the amount we recovered from success, and then we get our total net loss, which is our required fee. And then we prove it up here. This is our fee up here, and then we've got our probability of winning, probability of losing. Here's what happens, the total cost when we lose. Here's our recovery that is just netted out, and this is the amount we have to get back. So let's try and apply this. So now our theoretical development fee is this. Let's start with the average loss. Okay, let's put that up here, and then let's put the probability of success, and put this over here, and then we compute our total loss. Okay, and all now we can put recovered costs, and that's our total cost of our feasibility study plus our negotiation. And we put our fee, right, required fee. And the required fee is just this minus that, so this is a much smaller fee. And then a fee multiple. Okay, and we can take this one divided by the total amount we're recovering. So we've got a small recovery. We don't have 5 times or anything more. Now, if you put up here that there's the probability in our other stage, let's say the probability of success is in our second stage, the probability of success in our first stage is 60%, or 80%, and the probability in our second stage is only 20%. We're going to get a dramatically different result. Now I'm going to have to pause the video again and do that. Okay, so I admit I didn't save the file. I better save it right now. And I had to recreate things, and I had to recreate the Monte Carlo and blah blah blah. So that kind of is. Should I say you should save your file? Okay, and then we have this method where it's the average. This is the average loss. Average loss divided by the minus the success recovery. So let's just try it one more time. I've got the average loss, which is this, divided by the probability of success minus the cost if you succeed. So that's that's the amount we need to recover, and then we can figure out the multiple uh, from that. So I'm going to put this all on a separate page on my website, and of course this file as well. For me, this is a little more exciting than some of the other crap I've been doing. Like today, I was struggling with trying to balance goddamn balance sheet all day. Oh, shit, what a life. Now, the other thing I was just about to do, and when I stopped this and I didn't finish, is put a much higher probability of getting through the first stage. That you might think is good, but it's not good at all. And let's put a higher cost of the first stage. Okay? And then let's put a lower cost of the second stage and let's put a 50% probability. Let's put a 30% probability. Now, this is a lot more expensive because the option to escape after you have your first date is much less. You get stuck 70% of the time, and then you lose it later on. So let's understand, in this case, what happens to the multiple. Now, in our last case, our multiple was only 2.35. So our total development fee should have been 2.3 times of the development cost. And I just changed it, by the way, so whatever what it was just before, I'll leave that. Okay. Now we're going to redo the simulation and see what we get next. And of course, I'm going to hopefully save the file, and I'm going to hopefully show it to you. So it cleared everything out, and there we get it. All right. So in this case, when I changed the probability, it gave me a multiple of 3.24. Of course, if you change this and change the probabilities, we could make it do all sorts of things, and then we can go back to our original case. If I still have it. No, I don't have it here. That case with multiple stages. If we have multiple stages and multiple gates, all we'd have to do is, and I'm going to do this here, but I'm not going to do it for this file, and I don't feel like doing it today. Uh, this is like our stage one probability, stage two probability. We can figure out what the true cost is and what the true cost of losing all those cases are. And if it's, we go all the way back to the vaccine, okay, we can figure out how much money we have to, maybe we want to just get it back from the government, maybe we want to get it back from charging a really high price for vaccines, what have you, whatever you have. What an idiot thing to say. But however you're going to recover that cost, you want to figure out what your true cost is, and your true cost depends on this real option. This real option to get out of it, it depends on the different stages and the different probabilities. So I've wanted to, for years and years, find a case where real options can really help you.